We go once again, ladies and gentlemen, boys and girls, and children of all ages. You are now tuned into the Investor Show. So, ladies and gentlemen, on this episode here, you're probably tuning in wondering what are trips or what are tips. I'm sorry, what am I talking about? Trips. What are tips with the Treasury inflation protection securities? So, right here on this episode today, we're going to talk about what are trips, of course. We're going to talk about what is inflation, what are bonds, what are tips, how to buy them, and who are the people that use them. So in that episode, this is an episode that you think that can help you out, you tune into the right place. But ladies and gentlemen, boys and girls, and children of all ages, before we get started, go ahead and make sure. Hit the subscribe button, hit the bell icon, hit that like, comment, and share button. Once again, ladies and gentlemen, boys and girls, and children of all ages, you are now tuned into the Investor Show. As always, this is your gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we are going to jump straight into it. So the first thing we're going to get into is today's topic is water tips, Treasury inflation protection securities, acronym tips, and how to buy them with yours and truly, Prince Dykes. So first, what is inflation? Inflation is the consumer price index, something we talked about numerous occasions on this show. Inflation is pretty much the cost of things going up. And I love to use the scenario of how much a can of Coca-Cola cost when you was in high school versus how much it is today. And what I mean by that is people who's been out of high school for 10, 15, 20 years, you can know the price of everything goes up, right? So with that being said, the reason why this is such a big topic is everybody's worried about inflation now. Inflation. So you seen we dumped a bunch of money. We did a couple stimulus packages at the height of the pandemic, and we pushed all this money into unemployment. We gave all these stimulus checks out, all these PPP loans out. So you pushed a bunch of money into the economy, and then we have a bunch of money in the economy that increases the demand for goods and services. And when demand goes up and supply stays the same, this is what's kind of pushing prices up, and inflation is supposed to happen. The Treasury Department, not the Treasury Department, but the Federal Reserve Chair said he wants inflation to be around 2% a year. So what is this doing is this is decreasing the value of your money as time go on. The more money we print, the less the dollar can purchase, which is called purchasing power. So as inflation goes up, the purchasing power decreases. Use this as a scenario. 20 years ago, you take $10,000, you put it inside of a shoebox, and you never touch it. 20 years later, you come back, you still got the same exact $10,000, but you will know you cannot purchase as much things as you once could 20 years ago, because that means a decrease of purchasing power. Right? So that's what inflation is doing. It is the invisible tax that's going up, the price of goods and services that are going up. And this is tracked by something called the CPI, the Consumer Price Index. Now, the next thing is, what are bonds? Bonds are pretty much corporate debt. The government sometimes issues bonds, which is called a government bond. Corporations issue bonds sometimes, which is called a corporate bond. And then you have some cities and states, they have some bonds that they issue. They're called municipal bonds, muni bonds. So essentially what bonds are is issuing debt to raise money. So for prime example, let's say you live here in Denver, Colorado. They decide to build a new Broncos stadium. So what the city decides to do is to issue bonds, and they may issue the bonds and pay back a coupon of 3%, something like that. So essentially they're saying, give me $100. I'm going to give you this piece of paper, and I promise to pay you in this 10-year bond. I'm going to pay you back your $1,000 plus 3%. So you give me the $1,000 or $100, or what if you give me $1,000, I give you a piece of paper, and then I take the money, then I turn around and build a Broncos stadium that turns around and sell tickets and create revenue for the city. And then in 10 years, you get $10,000 and 30 cents back, if I did my math correctly on that. It's pretty simple and easy. So corporations do that. They do this as well. What they call it issuing debt. They pretty much borrow money from the public. Governments do it. The governments do it. corporations do it. And it's all type of people that issue bonds, but it's a way to issue debt to be able to raise money to do something else, and you get a piece of paper. So that's what a bond is. Now let's get into tips. What are TIPS? You always hear the acronym called TIPS. This is a Treasury Inflation Protection Security. So TIP is essentially, this is a bond like we spoke about earlier. This is a bond. You know, the bond said, hey, the problem is, let's say interest rates change over time. You know, interest rates go up, interest rates go down. You know, we live in a very low interest rate society. Interest rates may start to go up. Also, inflation may go up. So for prime example, you say last year you made 30% on the stock market, right? That was your total return. Now, what was your real return? The real return is when you subtract out inflation. So let's say if you made 30% off the stock market, inflation was at 3%. Now you only made 27, not only made 27, but 27% is your real return. So keep that in mind, real return. So somebody who buys a bond, they're saying, well, what if inflation goes up during this time period over those 10 years that you're going to pay me back? So what a Treasury Inflation Protection Security does is it gives you a portion of the inflation rate. So as the CPI goes up, depending on how your bond is set up, as your whatever the CPI is, the Consumer Price Index, inflation that we spoke about, if it goes up 2%, hey, we're going to pay your bond plus a little bit of 2% of this on top of it, right? Now, granted, you will be taxed on this. I would advise you to see a CPA, to depend on your situation, how you structure these. But essentially, this is what this is. So this is also giving you a bond, but also protecting you against inflation, which a lot of people are worried about. Now you're saying, oh, okay, Prince, that sounds kind of cool. So who uses TIPS? Who use them? Most of the time, people that use TIPS are people who are usually tuning into the show would probably not be interested or use these type of investments because, you know, I believe most investors are in two phases. Either they're in the accumulation phase where they're trying to accumulate as much wealth as possible, which is usually when you're in your 20s, 30s, 40s, and 50s, you're trying to accumulate as much money as possible. And then when you get to your 60s, 70s, and 80s and thereon, you're in the preservation phase where you're trying to preserve your capital. You're not trying to try anything crazy and new. Sometimes it could be shorter. Some people say, I want my 20s and 30s to accumulate all my money. Then I want to live off it from my 40s, 50s, and 60s and 70s, right? Or it all depends. It's accumulation phase and there's a preservation phase. So, hey, I want to make as much money in my 20s and 30s and 40s, and then I want to live off of it in my 50s, 60s, and 70s. Now, people who, if you're in the accumulation phase, unless I'm wrong on this, my opinion is TIPS are not for you. The reason why TIPS are not for you is because TIPS are for people who are more in the preserving capital phase, meaning that, hey, I have $10 million and I want a steady flow of income, but I don't want to be losing money to inflation, but I'm not really trying to jump into stocks and crypto and some new startup. I just want to have my money and to get a little bit protected. So some people may be more interested into saying, hey, you know what, put me inside of a TIP, something that can put me in a bond that's going to accumulate me some money, but also protect me against inflation. So people who are trying to preserve capital will be more interested in this. Or let's say if you got a part of a piece of your portfolio that you want to kind of keep it locked in and keep it safe. Let's say, you know, some money that you maybe, hey, I need this money in the next 5 years or 2-3 years or whatever. And you may not want to have this subject to what the market does. All right. So I look at people who are more in the preserving capital phase, things like that. Now let's get into where it really matters, how to buy them. So you can buy them two major ways that I know of. You can go to treasurydirect.gov. That is Treasury, TREASURY direct.gov. And you can create an account there. And right here, it tells you the site that I have pulled up that I'm showing on my stream. It says how to buy TIPS, right? Once you get to the site, you go to treasury.gov, type in TIPS, TIPS, or you can type in how to buy TIPS. And right here to tell you, you can buy Treasury Inflation Protection Securities directly from the U.S. Treasury or through banks, brokers, or dealers. So you can go to banks and brokers or dealers. Buying directly from the U.S. Treasury. To buy directly from the U.S. Treasury, you have to open up an account. So you can get it straight here, right? So right here to walk you straight through how you can submit a bid directly. Now, another way, you may be with a bank that offer it as well. Another way you can do this, let me share my other screen. Another way you can do this, instead of buying it directly, let me share my screen here. Y'all give me 1 second. Y'all bear with me. Shout out to everybody that's tuning in on this. I didn't think nobody would be in here live. I thought everybody was getting ready for the Floyd Mayweather fight, which I'm going to watch in a little bit myself. But anyway, right here, you can buy a TIPS ETF. So you can go in, the one that I have pulled up right here, you can go on TD Ameritrade, E-Trade, Charles Schwab, Interactive Brokers, and you can type in the word, there are all type of ETFs that are out there that are offered by Vanguard, iShares, you name it. Everybody has a TIPS ETF. So you can purchase an ETF. For prime example, this one is costing $127, and it is giving a monthly dividend of 68 cents currently, which is about 3.23% a year. And so far this year has been mostly flatline. So far this year has been right at $127 for the whole year, but you're getting that nice little dividend pushed in there as well. And you can look right down here, look at the strategy, read the strategy. This investment seeks to track the investment results of the Bloomberg Barclays U.S. Treasury Inflation Protection Security TIPS Index Series I, which composes of inflation protection U.S. bonds. The fund generally invests at least 90% of its assets in the bonds of the underlying index and at least 95% of its assets in U.S. government bonds. It may invest up to 10% of the invest up to 10% of the assets in the U.S. Treasury government bonds not included in the underlying index. So right here, you can read right here what it's doing. It'll tell you right here, most of the money is put into United States Treasury notes, which is like the most safest because it's backed by the U.S. government and it's going to protect it by inflation. All right. So let me see what y'all say in the comments before I roll up out of here. Okay. Know your boy 504 Foster. What's going on, man? He says, good evening, Prince. Okay, he says, good evening, Prince. I like to know, what is your opinion on the Spider TIPS ETF? Is that a better play than other TIPS ETF like indexes or Fidelity? I have to look into that on another episode because I can't break it. I would have to break them. I haven't looked at that one in particular, and I have to do a comparison. So I can't do that one on this episode. So I would say look at the expense fees. I would look at the expense fees, look at the yield, and then I will line it up to see how they perform. And then look at what they invested in. But they're probably close to the same if I was a guessing man. Christian says, I was just thinking about tips. Thanks, brother. No problem, Christian. No problem. Subi says, hello from California. Hello, Subi. Thanks for checking in. Thanks for checking in. And Know Your Boy said, no problem. That's why we're here. Trade ideas and learn. No problem. Thank you, guys. I've been wanting to do this episode, but I felt y'all probably wouldn't be interested in this, but I'm glad I got it out the way. Now, I'm going to go check out the fight tonight. And thank y'all for tuning in. I didn't think y'all be on here tonight. I thought everybody probably off watching something else. But enjoy the rest of your weekend. Until the next video, podcast, cartoon, or whatever else crazy you see me doing around the globe. As always, my name is Prince Dykes. This is The Investor Show. Peace. Be safe. I'm out, and thank you.